Greetings from New York City. This is CMQ Investing. My name is Franco. And in this video, we are going to dive into 9 investment mistakes that you should avoid making in 2024. If you consider yourself a long-term investor or you just want to build long-term wealth, please hit the subscribe button. I promise it will be worth your while. Make sure to also hit the notifications. That way you will get a notification every time a new video is uploaded. Now, these 9 investment mistakes are all backed by empirical evidence and academic research. They were also featured in a 2010 Library of Congress study about the common pitfalls that American investors tend to make. Mistake number 1 is active trading. Active trading just refers to frequent buying and selling of stocks. Studies show that the more often we buy and sell stocks in the short term, the worse our returns are in the long term. Barber and Odeon's research shows that frequent buying and selling is rooted in overconfidence. Most investors are overconfident without realizing it, and overconfidence is a killer. Avoid it at all costs. So if you have something that's really worth owning, you're just going to hold it for a long period of time, and that's where you're going to build the most wealth.
Figure out something that's going to work over the long term and buy that.
Mistake number 2 is the disposition effect, which refers to a tendency in investing where individuals like us are more likely to sell assets that have increased in value while holding on to assets that have decreased in value. We tend to sell winners too soon and hold losers too long. Studies find that when investors fall victim to the disposition effect,
I am not a victim.
How did
I'm a survivor.
Winners that they sold continue to outperform the retained losers, which is a completely counterproductive strategy, and that's why we want to avoid doing this. The next mistake is about focusing too much on the past returns of a given fund and focusing too little on the fees of that fund. If you're buying funds, make sure the fees are as low as possible.
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get.
One that I prefer is Vanguard's VOO, VOO, which has an expense ratio of 0.03%. It practically does not get any lower than that. I also own VTSAX, which has an expense ratio of 0.04%. I want to focus more, though, on the tendency for us to look at the past returns and assume that they're going to continue on into the future. I've made this mistake before. I've seen things that, hey, last year, it did 300%. And even though I don't assume that it's going to do 300% this year, I might think, oh, well, it'll do half of that, and that'll be awesome. It's just a flawed way of thinking that we're all very prone to doing. And remember that past returns are not a reliable indicator of future results. As much as I wish they were. That'd be awesome. The next mistake is not subscribing to CMQ Investing and not liking this video. If you do both of those things and you hit the notification bell, I hope all the best happens for you, because doing those 3 things goes a long way and it helps CMQ Investing grow. If you have done those 3 things, I really appreciate it. And I hope to hear from you in the comments as well. If you're a subscriber and you leave a comment with a request about a future video, your request goes to the top of the queue. The next mistake is familiarity bias. And it's about our tendency as investors to prefer investments that are familiar to us. Investors often show a familiarity bias in how they might prefer a local or national investment over something international. I think this can be a little bit misconstrued. I think, frankly, if I don't invest in emerging markets, I don't think it's because of familiarity bias. I think it's because I don't know what the hell's going on in an emerging market where I've never traveled. One of the emerging markets ETFs that I'm looking at by iShares, fees of 0.7%.
The bigger the profit of the management company, the smaller the profit that investors get.
That's a lot more than 0.03%. Nearly 16% of the fund is allocated to companies that are based in India. And while I have friends from India and I hope to travel there one day, I don't want to just blindly invest in this emerging market fund because, well, it's not because I'm biased to my home. I'm just biased to having a clue of what's going on. The real way that long-term investors like us can fall victim to familiarity bias would be investing too much in the stock of a company that you work for. Think Enron, think Fannie Mae. These were companies that people had poured so much of their retirement into the actual company's stock. When the company went bust, not only did they lose job security and their income from their job, but they also saw their asset just go down the drain.
Thousands of employees were fired, and their retirement and pension funds were wiped out. Shareholders and creditors lost billions.
Take our 401k, our retirement. Now they tell us we have no job. Merry Christmas.
The next mistake is called momentum investing. Momentum investing is a strategy based on the assumptions that the stocks that have performed well in recent years will continue to perform well. 2023 was an incredible year for NVIDIA, and by the way, I hope NVIDIA continues to have many more incredible years, but it could be a mistake to invest in NVIDIA assuming that the incredible past performance, that is the performance of last year, continues on this year. But a lot of investors make that mistake. Momentum investing is linked to the greater fool theory. It's also proven to lead to speculative bubbles. A study by Hong and Stein explains that momentum investing may cause short-term gains, but often results in long-term reversals when prices surpass intrinsic values. In long-term reversals when prices surpass intrinsic values. It's a very important idea. The next mistake, manias and panics. We can define a financial mania as a period of increasing speculative enthusiasm.
Our Bitcoin price target, which is more than $1 million per Bitcoin in 2030.
Peaking before a business cycle's apex, and it's often followed by a panic. According to economist Brenda Visano, this cycle progresses from optimistic uncertainty to intense speculation and perceived innovation.
Innovation solves problems.
Eventually leading to distress. A great way to avoid falling victim to this mistake is just to diversify. The next mistake is naive diversification. This refers to the tendency for investors to allocate their assets equally among all available options, regardless of how good those options actually are. Benartzi and Thaler did a study about this. Individual investors often evenly distribute their capital across the available options in their retirement plans. And while this can be a practical approach, it can lead to suboptimal outcomes if those available investment choices are poor. By the way, do you see there's a couple sleeping dogs behind me? Which is a great segue into the next mistake, noise trading. I don't want to be very noisy. Noise trading refers to the tendency for us to make investments based on short-term fluctuations in news and without considering the underlying fundamentals of the investment. Another study by Barber and Odeon titled All That Glitters shows how individual investors tend to invest this way, making buy and sell decisions based on attention-grabbing stocks rather than fundamental data. These stocks are categorized by their news coverage, that is the amount of news coverage surrounding the stock or the business, or by their abnormal returns or trading volumes. Most importantly, these stocks tend to underperform compared to the stocks that these investors sell. The implication of this study is that noise trading, which is often seen as related to day trading, it's like the cousin of day trading, is generally not a profitable strategy. And this goes back to the very first mistake we talked about, which is active trading. And if you really want to see the bigger picture here, try and see how many of these mistakes that I've mentioned tie back to our tendency to buy and sell stocks too frequently. The final mistake is under-diversification. And this is a bit controversial because it's not a one-size-fits-all mistake.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses.
In some cases, it makes sense to have very few investments if you know them in and out and they're sure things. In that case, you wouldn't want to be too diversified, but most investors could benefit from additional diversification. I appreciate you for hanging out with me. Thanks for tuning in, and we'll talk soon.